Welcome back to the deep dive. Today, we're opening up EFG's highly anticipated Outlook 2026 report.
Right?
And this document is, well, it's essentially a roadmap. It lays out the top 10 critical themes that are shaping the global economic landscape for the year ahead.
It's much more than just a forecast, though. I mean, it's a necessary synthesis of everything that's happening.
Like synthesis here.
We're distilling the most critical insights from, global policy trends, technological revolutions, especially the AI race, and, of course, where the real market opportunities are.
And the underlying theme is?
Volatility. The report is very clear on this. Unpredictability and this persistent shift toward a more multipolar world.
So that's our mission today, to give you the shortcut, to distill the most impactful nuggets of knowledge from this report. We're going to cover everything from the future of U.S. economic dominance to the just astonishing amounts of capital needed to fuel this AI revolution.
And the sources organize it really well around 4 pillars: global economics, policy trends, innovation, and then market opportunities.
Let's jump right into segment 1 then, starting with what the report calls U.S. exceptionalism.
Indeed. Theme 1 is the core forecast, and it's that the U.S. will be the fastest-growing advanced economy in 2026.
Okay.
And this isn't a political statement. It's just based on factors that point to continued, upside surprises, even while other advanced economies are struggling.
All right, let's unpack that resilience. The sources detail 6 specific factors. I see 3 structural and 3 cyclical. Let's start with the bedrock. What are the structural supports?
Structurally first, the U.S. economy has just proven remarkably resilient since the pandemic. It absorbs shocks and adapts, frankly, faster than its peers.
And second?
Second, there is a clear growth-oriented plan that's been articulated by Treasury Secretary Scott Bessent. It's the 3-3-3 plan.
Right, we've heard that number before. To be clear, what does 3-3-3 actually aim for?
It's aspirational, but it's concrete. 3% real GDP growth, a 3% budget deficit relative to GDP, and a 3 million barrels per day increase in domestic oil production.
So the idea is to outgrow the debt.
Exactly. The key insight here is that Bessent's theory of fiscal stability relies on rapid growth outpacing the rate of debt accumulation. They believe growth is the best debt stabilizer.
And the third structural factor. This ties right into the tech story.
It's IT leadership. The report highlights that IT investment alone contributed almost 46% of U.S. GDP growth in the first half of 2025. I mean, the U.S. is where the foundational capital for this global tech shift is really happening.
Those are powerful fundamentals. But what about the cyclical side of things, the timing?
Well, the cyclical timing is favorable. First, lower interest rates are expected. We anticipate reaching trough rates, the lowest point of the cycle, in the first half of 2026.
Which should spur investment?
Exactly. Business investment, consumer credit. Second, lower energy prices. They're acting as a powerful counterweight to the cost pressures from tariffs, providing some disinflationary relief.
And third,
you have fiscal stimulus still filtering through the economy from the One Big Beautiful Bill Act. Things like accelerated depreciation, R&D expensing, which are estimated to boost U.S. GDP by a full percentage point in 2026.
it's a compelling case for U.S. leadership. But what about the other major economies? How do they stack up?
The contrast is pretty sharp. I mean, China is still the dominant emerging market, yes, but it faces these persistent structural problems.
As debt, the property market.
Massive debt levels, weakness in the property market. They are significant headwinds. Europe, meanwhile, is mixed. It will get tailwinds from lower ECB rates and a big boost in German defense spending, but political instability introduces constant friction.
Which brings us neatly to theme 2. Trough interest rates in advanced economies and the opportunity this creates elsewhere. Help us understand this concept of the neutral rate.
So trough interest rates are just the bottom of the cutting cycle. The reason advanced economies have limited room to move is because their policy rates are already very close to the neutral rate, what economists call R-star.
The rate that's neither hot nor cold.
Precisely. It's neither stimulative nor restrictive. So if the Fed, for example, is already expecting strong real growth, cutting much below 3% would likely overheat the economy. It just limits their scope. That's the core insight here.
So, if the opportunity is limited in developed markets, where's the yield?
It shifts squarely to emerging markets, EMs. They started hiking rates much earlier and, frankly, much higher to fight their local inflation.
So their real rates are huge.
Exceptionally high. The prime example is Brazil. Its 10-year local currency bond yields are currently 13.7% against an expected inflation rate of maybe 4.2 to 4.5%.
Wow.
It creates a massive positive real yield opportunity. Mexico also benefits hugely from U.S. strength, which gives significant support to the peso.
But that high yield comes with fiscal risk, which is theme 3, bond markets. The report warns to beware of shark-infested waters.
Yeah, the sharks are circling countries where fiscal policies are seen as unstable. In the U.S., the debt path is steep, projected to rise from 100% of GDP in 2025 to 119% by 2035.
But there's a plan, at least.
There is. Stabilization is plausible if Besant's 333 plan works, and if the forecast, and it is a forecast of $400 billion a year in new tariff revenues, materializes.
Okay, that's the U.S. Where are the concerns sharper in Europe?
Europe is dealing with more internal structural stress. I mean, comparing France to the new Greece is probably a stretch.
A bit dramatic.
It is because of French liquidity and positive growth, but the market concerns are definitely sharper than in the U.S., and even more vulnerable is the U.K. It just has very low credibility on its debt limits.
The Liz Truss moment.
The risk of repeating that 2022 moment where bond markets just staged a revolt over unfunded spending is still a very live possibility there.
Okay, moving to theme 4, the geopolitical reality. New alliances, state capitalism. Let's start with the U.S. and China. How do you define that relationship in 2026?
It remains tense. You have continued de-risking in critical areas, semiconductors, rare earths, but the deep interdependence hasn't gone away. The consensus view is that a pragmatic, sort of transactional relationship is the most likely path forward.
What's really fascinating here is the ideological shift the sources identify.
Yeah.
They label it capitalism with American characteristics.
It is an undeniable irony. The U.S. government is adopting tools you'd normally associate with Chinese state capitalism. They're taking strategic stakes in domestic champions Intel, MP materials.
Right.
And crucially, they're using export license conditions to exert control. The detail here is staggering.
Go on.
They are forcing major tech firms like NVIDIA and AMD to hand over an equivalent of 15% of their China revenues for continued access to that market.
Wait, 15% of revenue, that's not a tax or a fee.
It's structured as a condition of the export license. It's effectively a strategic tariff on access, and it just shows the extent to which the state is willing to intervene to direct technological development. It's a profound structural shift for the U.S.
And globally, this is all accelerated by new alliances, specifically BRICS.
Absolutely. With Indonesia joining in 2025, BRICS now has 10 members. And the sheer economic pull is evident. The bloc accounted for over half of global GDP growth in 2025.
And at the same time, trust and leadership is eroding.
Deeply eroded across many advanced economies, and that will be tested by the U.S. midterm elections in November 2026.
Okay, let's shift our focus to domestic policy and innovation in segment 2. Theme 5 outlines Trump's 3 Ds: DOGE, deregulation, and drugs.
It's a very focused, efficiency-driven agenda. The first D is DOGE, the Department of Government Efficiency.
Right.
This is a massive effort aimed at reducing wasteful federal spending. And by mid-October 2025, they had already achieved estimated savings of $214 billion through asset sales, contract cancellations, things like that.
A huge immediate saving. But the long-term potential seems to be in the second D, deregulation.
Correct. The key focus areas are finance and housing. On housing, the agenda is all about dezoning and rezoning land. And the analysis here is astounding. One study suggests that if all U.S. metropolitan areas simply adopted the lowest regulation level, like in Texas, U.S. GDP could potentially increase by 3%.
3%, just from removing regulatory friction. That's a stunning number.
It is. It's a fundamental structural change being chased.
And in finance.
The Genius Act is the key piece of legislation. It's aimed at establishing regulated stablecoins. The sources suggest this is aimed squarely at disrupting slow, high-cost, cross-border payments.
And the final D, drug pricing. This one's pretty contested.
Very. The administration has a clear stance. U.S. drug prices must stay high to incentivize R&D. So the strategy is to use leverage, like tariffs, targeting countries like Switzerland, to pressure global partners to align their drug prices up towards U.S. levels.
Now we come to the defining competition of our age. Theme 6, the AI race. We all know this requires immense capital, but the raw numbers here are just something else.
The investment scale is truly historical. You look at the top 4 hyperscalers, Amazon, Microsoft, Google, Meta. They spent a combined $97 billion on capital expenditures in Q3 2025 alone.
In 1 quarter.
1 quarter. A 66% year-over-year increase. We're seeing figures suggesting that global data center investment may have exceeded $500 billion in 2025. This isn't just a spending boom, it's a fundamental rewiring of global infrastructure.
And this scale of build-out creates an obvious choke point: energy.
The energy challenge is immense and urgent. AI data centers are uniquely power-hungry. They consume roughly 10 times more energy per server than traditional ones.
10 times.
Yeah. The report cites forecasts showing data centers' share of total U.S. energy consumption is expected to surge from about 4.3% in 2024 to 11.7% by 2030.
That's a threefold increase in less than a decade.
Driven by one technology, we're talking about potentially straining grids across the country.
So how are companies even financing this? The traditional VC model can't cover this scale.
No, the funding sources are evolving fast. At first, it was free cash flow. But as cash flows tighten, we see capital coming from debt, equity, and crucially, vendor financing. The ultimate example is NVIDIA agreeing to invest up to $100 billion into OpenAI.
Is that really vendor financing? Or is it more like a strategic M&A deal disguised as a partnership?
It's a hybrid model, and it really underscores the need for vertical integration. It shows that the traditional capital markets alone are insufficient. Strategic vendors, like NVIDIA, have to actively finance the downstream demand for their own chips to ensure their ecosystem even thrives.
And what's the next frontier after the AI brain?
The body. Humanoid robots. They're moving decisively from labs to the factory floor. The critical development is the cost curve. Costs are just dropping rapidly from well over $100,000 to the $35,000 to $60,000 range.
And Chinese firms are aiming even lower.
Ambitiously targeting units under $15,000. This makes their mass deployment an economic reality, not some sci-fi idea.
Let's move to segment 3 then and look at where investors can find opportunity. Theme 7 suggests an EU revival. What's driving the excitement for European and Swiss equities?
There are three forces converging. First, the commitment to defense spending is just massive. All EU NATO members are expected to hit or exceed that 2% of GDP target in 2025, with an even more ambitious target of 5% by 2035.
That's a deep and sustained industrial stimulus.
It is. And they're also showing policy leadership on the green transition with the Clean Industrial Deal. Renewables already provided nearly half of the EU's electricity in 2024.
And finally, innovation.
Europe is an innovation powerhouse. I mean, 16 of the top 25 most innovative economies are European. Switzerland has been #1 for 15 years straight. And you see it in the real world, like Klarna's AI assistant now doing the work of 700 full-time agents.
Okay, Theme 8 argues that emerging markets have the wind in their sails, escaping that value trap label. What's driving this optimism?
The alignment is strong. First, valuation. EM equities are trading at a wider than average discount to developed markets. They're just more attractive.
And the dollar helps.
A stable to lower U.S. dollar environment helps ease debt burdens, for sure. But the most important factor, and it's often overlooked, is fiscal discipline. Many key EMs, like Mexico, Brazil, India, they actually hold lower government debt to GDP ratios than the U.S. or Japan. They are, in many ways, fiscally healthier.
And they have commodity power.
Precisely. Global commodity constraints benefit them. China, for instance, has near dominance in rare earths, holding almost half of global reserves and doing over 90% of the refining. That gives them immense geopolitical and economic power.
Theme 9, private markets. They've grown rapidly but have a liquidity problem. How are firms addressing this?
They're focusing on strategies that aren't dependent on volatile public markets for exits. So mid-cap buyouts, for instance, offer diversification and more attractive entry valuations.
And secondaries.
Crucially, the secondaries market buying states and existing funds is poised for explosive growth. It provides immediate liquidity and diversification. And historically, secondaries have also outperformed primary funds in recent vintages.
And for defensive strategies.
Private debt remains a key defensive asset class. It's provided stable returns between 7.5% and 10.8% over the past 5 years, mainly because the loans often have floating rates, which protects you against interest rate changes.
But manager selection is key.
It's everything. The disparity between top and bottom quartile returns is just massive.
Our final theme, number 10, suggests we'll see a normalization of deal activity in IPOs and M&A. What's the outlook for 2026?
We expect a sustained recovery in IPOs, driven by sectors that demand massive new capital. So AI, biotech, clean energy.
And this is a global story, not just a U.S. one.
Very much so. In the first half of 2025, IPO volume in India and China almost matched the U.S., with China actually raising higher proceeds, bolstered by chip and semiconductor listings.
And what about SPACs? Are they making a comeback?
The sources suggest they are, and that they're finding a specialized niche role, particularly in sectors like biotech, where speed to market is critical. This is supported by enhanced SEC disclosure rules that offer more protection to investors.
And M&A.
M&A activity will be strategic, focusing on transformative deals, securing supply chains, accelerating digital and green transitions, rather than just opportunistic volume.
This has been a monumental deep dive. From the surprising strength of the U.S. economy to the staggering, $500 billion annual spend required for AI, those two themes feel like the most critical drivers for 2026.
Absolutely. And I think that leaves us with the final provocative thought for you to consider.
Give her
The outlook details these massive targeted government initiatives, Besant's 333 plan, the DOGE's style savings effort, and at the same time, this unprecedented, unconstrained private corporate capital just racing to fund the AI infrastructure build-out.
right.
So the question is, which of these two forces targeted state-level planning or unconstrained corporate capital racing for technological supremacy? Which one will ultimately prove to be the most effective mechanism for growth and determine the global trajectory in the years ahead?
That distinction between state direction and private competition, that is the critical question. Thank you for joining us for this deep dive into the 2026 outlook. We encourage you to explore these concepts further.